Hello and welcome to Live Wire Markets. My name is Chris Conway. For today's Fund in Focus, I'm sitting down with Roy Keenan, who is the co-head of fixed income at Yarra Capital Management, to talk about the Yarra Enhanced Income Fund. Roy, good to see you again.
Yeah, it's great to be here.
Let's talk about the Yarra Enhanced Income Fund. What is the performance objective that you're shooting for?
I've been managing a fund for 22 years now coming up, and what's been really pleasing, that return target hasn't changed in that 22 years. We've been trying to do cash plus 230 to 280.
Yep.
And we've delivered, with that in mind, we've delivered that with cash plus 365. So,
wow.
Yeah, so it's been a great outcome for us and something we're pretty proud about.
Roy, what is the expectation around rates and how will you position the portfolio for that environment?
Yeah, look, it's a really interesting time at the moment. Our base case at Yarra is that, we think that the RBA will cut rates twice this year, probably August, November, and the Fed 4 times. But in some ways we have in brackets, there may be none at all.
Yep.
And I think that's a good environment for a fund like the fund I manage, the Yarra Enhanced Income Fund, because essentially that means sort of in some ways higher for longer. The longer rates stay up, the more we earn income, and essentially that's music for my ears in some ways, and it helps us to sort of think about that portfolio construction to benefit from that higher rate for longer environment. With that in mind though, when you talk about higher rates for longer, you also got to think about the credit quality.
Roy, just a thread that I might pull on there if I may. Why the variability? So obviously the house view is that we'll see a couple of rate cuts, but you said there's the possibility that we'll get none.
Yeah.
So what's creating that uncertainty?
So I think there's 2 aspects to this. Yes, we'll see lower inflation, but in some ways we think that growth will start to pick up, and not just domestically in Australia, but globally as well. And Tim Toohey, who's our macroeconomist and strategist, has been pointing to the sort of industrial cycle. And we're really starting to notice that the sort of emerging markets are starting to lift their growth prospects. And if that comes to fruition, if you think about in Australia, if we start to get higher growth coming through, lower inflation, but we have tax cuts which are going to support, it's probably going to be problematic for the RBA to be too aggressive about cutting rates. And they might sit back and wait to see how things develop.
Roy, a hard landing, no one really wants to talk about it, but what would the portfolio look like if there was to be a hard landing? What impact would it have?
Yeah, look, it's an interesting environment. Getting back to that interest rates, the one thing higher interest rates does for us, it sort of immunises the portfolio a bit. We've got a running yield of around 6.5% today. And I think that, there's probably a couple aspects to answer that question. And the first one is credit quality. We're probably running the highest credit quality in 22 years in the fund. We're not doing that because we're concerned about credit. We're doing that because we think you don't need to run as hard in today's interest rate environment to generate the return targets for this fund. It's a really good environment. And in some ways, where we see risks from a hard landing is in sort of higher yield credit, where higher rates for longer would mean that debt servicing costs for companies that are more levered, with higher gearing, have less cost controls in their business, will struggle a bit more. And we're probably running the lowest high yield component in our fund for a number of years now. So, I think that's one aspect to the hard landing. Yep. The other aspect is interest rates. And, if hard landing was to sort of develop, we would be, in some ways protect not only from the credit quality, yep. And I have to say hard landing is not our base case. Sure. We think a soft landing is our base case.
Yep.
I would think that, we're going to do okay because, yes, you might have a little bit of a credit deterioration in a hard landing, yep. But what you will find is that, we have interest rate duration a little bit higher, and what one will take away from credit deterioration we should get from an interest rate rally.
Roy, you talked about quality and you just referenced duration. What duration are you currently running and why?
Yeah, so we are currently at 1.4 years in my fund, right. Which in some ways is a little bit longer than we would historically be. Yep. Some ways it is to protect that hard landing. In some ways it's also to protect income. We can do that because our fund's sort of 70% floating rate. we can actually, in some ways, if we think that the markets are a little bit different to what what it's forecasting for the central bank is different to our view, we can actually lock in some of that floating rate exposure or expose ourselves to a interest rate rally. And in some ways, in the last sort of 3 to 6 months, adding a little bit more duration into our portfolio has come about by doing a bit of that income protection, but also concentrating on probably the sort of area of the market that we think is really good value at the moment, and that's fixed rate tier 2 paper from banks and insurance companies. And we've been really keen to add to that into our portfolio, which has added a little bit of duration, giving us a really good running yield at the same time and yield to maturity, but also in some ways protects against that hard landing. Now, I think a hard landing would only occur if the RBA was to start tightening rates again, and hence why it's not our base case.
Roy, you and I have spoken a number of times, and in the past you've said to me that you don't mind taking the risk, but you want to get paid for it. Is that right?
Absolutely, that's our motto.
Yep, fantastic. So, last question for you: what benefits does the fund offer investors within that prism?
The key benefit from an investor is consistency in income. Yep. We've paid about 260 to 270 over cash for 22 years now, and I don't really see that changing as an income distribution. I don't see that changing over the coming years, especially when you have a higher for longer environment. From my perspective, the fund is very diversified, but I think we're in a really good environment today where we can give investors alpha. I'd say going back in that low interest rate environment, we had to run really hard and work really hard to deliver alpha. Yep. Today's a totally different environment, and we can invest across the capital structure of the banks. We have a much preferred, at the moment we have a preference for tier 2 over tier 1. Some investors who just want to buy ASX hybrids on the tier 1 market, they will essentially, they're only exposing themselves to one segment of the market. Coming to a manager like myself in a fund like the Yarra Enhanced Income Fund, they can get exposure to a much broader marketplace, both on the listed space but in the professional over-the-counter space.
Roy, thanks so much for sitting down with Livewire.
Great, thank you.
If you enjoyed that Fund in Focus as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.